The 3 lessons from capital market history is related to this risk-return trade-off. There is a reward for bearing risk. The greater the potential reward, the greater the risk. The total dollar return is the income from investment plus or minus the capital gain or loss. Total percentage return. The return of an investment measured as a percentage of the original investment. Percent return equals dollar return, dollar invested. The dividend yield is your income divided by the beginning price, aka D1, P0. The capital gains yield is beginning price, P_0. The total percentage return is your dividend yield plus your capital gains. Why are financial markets important? They provide a means to channel savings to investments, which strengthens economic activity since there is people can be compensated for investing and those who need to borrow have the availability to do so. Additionally, they provide us the info about the returns required for various levels of What are the 2 parts of total return? Capital gains and dividends. Why are unrealized capital gains or losses included in the calculations of returns? Because our decision to cash out or reinvest does not affect return. What's the difference between a dollar return and a percentage return? Why are percentage returns more convenient? This way, our return does not depend on how much money we invest, it is how much per dollar invested. Large company stocks are comprised of a common stock portfolio based on S&P 500. Small company stocks. A stock composed of the smallest 20% of companies listed in NYSE. The largest historical return was 142.87% in 1933. Long-term corporate bonds. These are based on high-quality bonds with 20 years to maturity. Long-term U.S. government bonds. These are based on GOVT bonds with 20 YTM. The largest historical return was 44.44% in 1982. U.S. Treasury bills. Based on T-bills that have a 1-month maturity. How many shares are traded globally per day? 10 billion. Research findings. Stocks of small companies have higher returns than those of larger companies. More liquid stocks have higher valuations but lower returns. What was the longest winning streak for large company stocks? (1991 to 1999). Historic average return is the average of individual values for X many years. Historical average returns from 1926 to 2011, large company stocks. 11.8% with risk premium 8.2%. Historical average returns from 1926 to 2011, small company stocks. 16.5% with risk premium 12.9% and have largest SD. Historical average returns from 1926 to 2011, long-term corporate bonds. 6.4% with risk premium 2.8%. Historical average returns from 1926 to 2011, long-term government bonds. 6.1% with risk premium 2.5%. Historical average returns from 1926 to 2011, U.S. Treasury bills. 0.036. Historical average returns from 1926 to 2011, inflation. 0.031. Risk-free rate. The rate of return on a risk-less investment like T-bills. Risk premium. The excess return, ERF. Risk is measured by the volatility of returns, and the greater the volatility, the greater the uncertainty. What measures the volatility of asset return? Standard deviation and variance. What is the historical variance? The sum of squared deviations from the mean all over the number of observations minus 1. From November 2007 when the decline began to March 2009 when the decline ended. The S&P 500 lost 50% of its value. In 2008, there were 18 days where value of S&P 500 changed by more than 5%. There were only 17 moves BETW 1956. Wow! From March 2009 to February 2011, the S&P doubled in value. The fastest doubling since 1936. Normal distribution. A symmetric frequency distribution, bell-shaped, completely described by the mean and variance. Arithmetic average. Answers this question: what was your return in an average year over a particular period? Geometric average. Answers this question: what was your average compound return per year over a particular period? Less than arithmetic average. Which average is better? Well, the arithmetic AVG is overly optimistic for long horizons while the geometric is overly pessimistic for short horizons. When to use the different AVGs. Use arithmetic when up to a decade in the future. Use geo when many decades in the future. Split BTW. Then when a few decades in the future. Efficient capital markets. Stock prices are in equilibrium, meaning fairly priced. If this is true, then you should be able to earn abnormal returns. Efficient markets do not imply that investors can't earn a positive return. Stock price reacting to new info according to efficient market. The price will instantaneously adjust to and fully reflects new info. There is no tendency for subsequent increases to occur. Stock price reacting to new info according to delayed reactions. The price partially adjusts to the new info. 8 days elapse before the price completely reflects the new info. Stock price reacting to new info according to overreaction. Price overadjusts to new info. It overshoots the new price and subsequently corrects. What makes a market efficient? Prices should reflect all info available to the public since we have investors researching stocks. If investors stop researching, then the market will not be efficient. Active management. Broken into two categories: fundamental analysis, which is long-term oriented, company and industry specific, and tech analysis is historical trends, patterns and charts covering market supply and demands, and short-term oriented. To clarify misconceptions about TMH. You can make money, you will earn a return appropriate for the risk, no bias in price that can be exploited to earn excess return, will not protect you from wrong choices if you do not diversify. Strong form efficiency. Here, prices reflect all info, including public and private. If the market is strong form of efficient, then investors could not earn abnormal returns. BC everyone has same info, markets are not strong form efficient and insiders could earn abnormal returns. Asterisk inside info is of little use. Semi-strong form of efficiency. Here, prices reflect all public available info. If the market is semi-strong, the investors cannot earn abnormal return by trading on public info. Asterisk fundamental analysis is of little use. Weak form efficiency. Here, prices reflect all past market info, price and volume. If the market is weak, then investors cannot earn abnormal returns by trading on market info. Implies that tech analysis will not lead to abnormal returns. Markets are generally this form efficient. Asterisk tech analysis is of little use.